Today, we're diving into a story that honestly feels like a Hollywood thriller, but it actually unfolded right in the middle of the global financial markets. We are going to break down exactly how a multi-billion-dollar coffee empire was built completely from scratch using a tech startup playbook. It's a hyper-aggressive growth strategy that ultimately led to one of the most brazen, jaw-dropping financial frauds in modern corporate history. $12 billion. Poof, just gone. Overnight, that massive amount of market value completely vanished. But what really evaporated that day wasn't just the money. It was the powerful illusion that Wall Street's most prestigious gatekeepers actually do their due diligence. It totally shattered this cozy assumption that, well, if the biggest banks and auditors are involved, everything just has to be legitimate, right? So how exactly did this happen? Section 1. The Uber of coffee. It all kicks off in 2017. Founders Jenny Can and Charles Liu didn't just want to sell a good cup of coffee. They wanted to totally dethrone Starbucks in China by applying a ride-hailing app model directly to caffeine. We're talking app-based, delivery first, and heavily discounted. And the sheer intoxicating velocity of that growth playbook was absolutely staggering. I mean, get this. From January 2018 to March 2019, Luckin Coffee opened an average of 5.2 stores every single day. Just try to wrap your head around the logistics of that. This kind of hypergrowth wasn't just fast, it was a deliberate, weaponized tactic that completely seduced top-tier venture capitalists and sovereign wealth funds, who were just terrified of missing out on China's next great consumer brand. To put that insane speed into perspective, by December 2019, in barely 2 years of existing, this hyper-expansion meant Luckin officially had over 4,500 stores, which actually meant they had more locations in mainland China than Starbucks, a company that had spent decades meticulously building its footprint of 4,100 stores. At the time, it looked like the ultimate disruption. Let's look at Section 2, the growth playbook. To really understand this, you have to know a little secret. Charles Liu was actually a car guy, not a coffee guy. He had already used a very specific tech startup playbook to build two other massive empires, Car Inc. and UCar, before looking for his next big act. So let's break down the exact formula they deployed here. Step 1. You raise massive amounts of capital. Step 2. You subsidized aggressively. And I mean aggressively, we're talking buy one, get one free promos and endless coupons that made a latte literally cheaper than a bottle of water. Step 3. You grow at any cost, just totally flooding the market. And finally, step 4, you rush to a public listing, launch an IPO, and exit rich. The whole thing is a machine designed purely for speed. But here's the catch, right? The fatal flaw in this playbook is that a machine running this fast is eventually going to overheat. From 2017 through March 2019, Luckin burned through $500 million. They were just torching cash to fund those insane promotions and practically free deliveries. The whole business model only functioned if the growth metrics kept going up and up. And when reality couldn't keep pace with the playbook, well, the numbers had to be invented. Which brings us to Section 3, faking the numbers. To keep this aggressive growth playbook running, and honestly, to keep that lucrative IPO narrative alive for hungry investors, the fundamental unit economics of the coffee shops had to be completely fabricated. Starting in April 2019, which, by the way, is incredibly right before their massive NASDAQ IPO even officially closed, Luckin began fabricating transactions. Over the next several months, they would ultimately conjure up $310 million, or roughly 2.2 billion RMB, in entirely fake sales out of thin air. And the mechanics of the fraud were just brazenly simple. They didn't use some incredibly complex offshore shadow banking vehicles. Nope. Instead, they literally just sold millions of bulk coffee vouchers to third-party shell companies that were actually tied to the founders' relatives and friends. Then, to cover their tracks, they inflated their expenses by $190 million, created a completely fake operations database, and simply altered their accounting and bank records to match the fake cash that was supposed to be coming in. But wait, it gets crazier. The absurdity hits its absolute peak with a supposed employee named Lynn Liang. This wasn't a typo on a spreadsheet. This was a completely fictitious human being invented by the company to process $140 million in payments for raw materials and deliveries. Let that sink in. A totally fake person moving very real money to hide completely fake sales. It is staggering to even think about. Moving to Section 4, the House of Cards. The grand illusion finally climaxed in January 2020. The stock had surged 149% from its IPO price, soaring over $50 a share. The company had just raised another $1 billion, and management's lockup periods were ending. The party was at its absolute peak. But while they publicly claimed a profitable 64 million RMB quarter in late 2019 to secure all that extra financing, the devastating reality was a 357 million RMB loss. The whole profitable store model that convinced the world to invest, entirely a mirage. So, the massive flashing red question here is, how did no one notice? Think about the players involved here. Ernst & Young was the auditor. Credit Suisse and Morgan Stanley underwrote the IPO. BlackRock was an investor. These prestigious gatekeepers completely missed the bulk voucher scheme and the imaginary employees. Why? Because the growth playbook, this incredibly seductive idea of a tech-driven Starbucks killer in a market of 1.4 billion people, was simply too good and way too profitable for them to question. Well, the unraveling of this house of cards was just as fast as the initial growth. Following that explosive IPO in May 2019, an anonymous 89-page short seller report suddenly dropped in January 2020. And this wasn't just a hunch. The researchers had collected over 25,000 physical receipts and thousands of hours of store video, proving the numbers were utterly fake. By April, this undeniable mountain of evidence forced Luckin into a shocking, midnight admission of massive fraud. But you know what's truly wild? The market's initial reaction. When that exhaustive short seller report first hit in January, Luckin issued a press release that categorically denied all allegations. They offered literally zero data to prove their innocence, just a flat denial. And astonishingly, desperate investors on Wall Street, who were so eager to keep the China growth story alive, blindly believed them. The stock actually recovered for a while, and the CFO just kept telling people the financials were, quote, robust. Which brings us to our final part, Section 5, the unbelievable comeback. Okay, so the truth finally drops. Luckin gets delisted from the Nasdaq in June 2020, hit with a $180 million SEC penalty, executives are fired left and right, and the whole thing looks completely dead in the water. But miraculously, a restructured Luckin Coffee survived. They closed the unprofitable stores, cut out the crazy discounts, and actually managed to become a genuinely profitable company with more stores than Starbucks again. But here is the crazy twist. The ousted founders, Charles Liu and Jenny Qian, they didn't just disappear into the shadows. They immediately moved on to run the exact same scheme all over again. In October 2022, those very same founders launched Luckin Coffee. And guess what? They are aggressively applying the exact same hyper-growth, discount-heavy playbook. They're out there selling coffee for 9.9 yuan a cup. They hit nearly 1,200 stores in just a matter of months. It's the exact same people, running the exact same model, and incredibly, investors are eagerly lining up again, because once again, the rapid growth story is just too seductive to ignore. As we watch this exact same playbook unfold today, we are left with a massive $12 billion question to ponder. Thinking back to Luckin's executives standing confidently in front of investors while their own spreadsheets were essentially burning to the ground, what's actually worse? Is it worse that the financial watchdogs, the auditors, and the CFOs are outright lying to us? Or is it more terrifying if they genuinely have absolutely no idea that the coffee they're selling was never actually poured? It's definitely something to chew on the next time you see a growth playbook that looks just a little too good to be true.